Well, you might have seen recently that Michael Burry is back in the news, and that is because he has just released his latest 13F filing, giving us a peek behind the curtain as to what he's doing with his own stock portfolio. And while Michael Burry definitely can chop and change a lot from quarter to quarter, making it difficult to take away any strong themes in what he's thinking, well, in this 13F, things were a little bit different with two prominent themes emerging. So what on earth is going on with the Big Short investor's portfolio? Well, having a look to the changes in his portfolio, there was, as usual, a lot of chopping and changing. He sold out of 14 stocks, including Google, Amazon, Oracle, and more. He added to 11 positions, and then of note, he bought 5 new stocks entirely. And that's where the first big story emerges, because one of these stocks is in fact Sprott Physical Gold Trust. In Q1, he bought over 440,000 shares, representing 7.37% of his US portfolio. And this is super interesting because, as the name suggests, this is an investment in physical gold. Specifically, Sprott is a closed-end fund that holds assets in physical gold bullion. But with gold prices at practically all-time highs and the price of Sprott's gold fund similarly touching all-time highs during Q1, which is when Burry bought it, on face value, it seems odd that Burry would be so keen to get in. He is, after all, a value-minded investor. But gold, as we know, is an interesting commodity. Gold is a commodity that investors flock to in anticipation of economic uncertainty and particularly in anticipation of inflation, both factors of which we know Michael Burry is acutely aware of. In fact, Burry's investment in Sprott Physical Gold Trust does align with his now long-standing concern about economic instability and market volatility. It's no secret that Burry has been quite wary of economic conditions over the past few years, as was evidenced back in his tweeting era, and I can't imagine his stance has changed at all over the past year or so. Gold has historically been a safe haven asset during times of economic uncertainty, providing a hedge against potential market downturns. As we can see here, the price of gold spiked back in the Great Depression, skyrocketed back in the 70s, for a reason we'll discuss in a second. It also spiked up coming out of the tech bubble, and particularly after the 2008 global financial crisis, and more recently, it also spiked around the time of COVID. Historically, it has been viewed as that safe haven against economic storms, and while that is mostly psychologically driven, the trend certainly still exists, and Michael Burry is seemingly jumping in, hoping the uptrend we've seen in gold since October last year continues with all that's happening in the world, from tariffs and elections to wars, supply chain disruptions, and inflation. And that leads us to the other reason beyond economic downturns that investors like to flood into gold, and it's a similar argument to what the crypto folks argue, that it's a hedge against the debasement of a currency and it's a hedge against inflation. Now, I don't have to tell you guys that over the last few years, we've seen some enormous sums of money printed, and we've seen that lead to some quite high levels of inflation. It's no Zimbabwe, but 9% for the United States was pretty bad. And the thinking of investors during these times is to convert their hard-earned cash into something like gold, or as has been argued more recently, cryptocurrency, because it's a more finite resource and the value can't be eroded in the same way that a currency like the US dollar can be. So that's why you saw a lot of chatter about crypto and gold while the Federal Reserve was printing a lot of money a few years back and when inflation was really hot. But here's the thing, inflation has cooled considerably since then, and the Federal Reserve is no longer printing more USD. In fact, since mid-2022, they've been lowering the money supply. So why is Burry buying gold now? Well, it's a surefire sign that he does not believe inflation has been controlled. Just like his tweets hinted at a few years ago, this move is most certainly an indication that Burry believes we are likely to see inflation pick back up, causing more investors to flock to gold, causing the already high price to rise again. That's the thesis. So that's the takeaway from Burry's purchase of Sprott Physical Gold Trust. But beyond that, we also have another big theme from his 13F to hone in on. But before we do, we need to talk about internet safety. Have you ever tried Googling your name or email address? I try to never Google my own name, but someone prompted me to do it the other day, so I did. And it's kind of concerning just how much data came up. It certainly doesn't feel great knowing that sometimes your personal details can leak out for data brokers to pounce on and sell. Data brokers sell your information to scammers, spammers, and anyone else who may want to target you. Your full name, your email, your home addresses, your health records, your relatives. Sometimes without you knowing, it's all out there. And that's why I've been using Aura, the sponsor of today's video. Aura shows me which data brokers are selling my information and automatically submits opt-out requests for me. Cleaning up my information not only helps reduce the amount of spam that I get, but it protects me from the hackers who could use this information to help them access my bank accounts, my sensitive information, or my personal nightmare fuel, someone hacking my YouTube channel. I don't know if you saw this, but AT&T revealed that over 73 million customer records, both existing and former customers, were released on the dark web. They recommended those affected use strong passwords, monitor account activity, and consider credit freezes or fraud alerts from credit bureaus. Well, luckily, Aura does this all for me. And best of all, I don't have to download several different apps just because a company couldn't keep my data secure. If my info was compromised in the AT&T data breach, I can breathe easy because Aura is always on, always doing the hard work of keeping my info safe. It's definitely worthwhile if you value your privacy. You can go to aura.com/new money to start your 2-week free trial. It's also linked below in the description. And thanks to Aura for sponsoring this video. Now, moving on to Michael Burry's second big theme coming out of his 13F filing. It is his continued purchasing of the Chinese tech giants. In Q3 of last year, Burry bought into both Alibaba and JD, which are both large Chinese e-commerce sites. But what surprised investors is that he significantly increased these positions in the following quarter and has now significantly increased the bet once again. In fact, he added 80% to his JD position and 66% to his Alibaba stake in Q1. So in a portfolio that is known for being totally overhauled on a regular basis, these two Chinese tech giants have now stayed at the top for 3 straight quarters. And in fact, Burry has even opened a position in Baidu this quarter, which seems to suggest he is really doubling down on China, although it is worth mentioning that his Baidu bet is considerably smaller, less than half the size of his Alibaba and JD positions. So what's the story here? Well, these 3 companies are obviously massive companies, integral to China's broader economy. They're massive market leaders. These companies have amazing competitive positions. Their products and services are relied on by the masses. But the thing is, none of these businesses have been doing very well over the last year or two because China's broader economy has been really struggling. The stock prices tell you a lot. Baidu is down 2/3 from their 2021 highs. Alibaba is down roughly 70%, and JD is much the same, down 67%. And this has to do with China's broader economy. It's been well reported that China's economy went through an extremely sluggish recovery after COVID, and that's partly because, unlike the Western world, China opted not to do wild-scale stimulus involving printing a lot of money. Beyond that, they've also had big problems in their property sector with property valuations falling and real estate developers going bankrupt. And this has fallen onto Chinese citizens who have had to weather the storm by simply tightening the belt. And that's shown in the data too. This report by McKinsey & Company shows that Chinese citizens are locking their money away. In 2023, China finished with urban unemployment of 5.1%, the same as pre-pandemic levels. Inflation was 0.2%. Consumers saw a rise in their average disposable incomes by 6%. But as McKinsey notes, consumers preferred to sock their cash away in the bank rather than spend it, pushing the savings rate higher. The savings rate in China hit 31.7% in 2023. This is propelling the country's total pool of savings to record highs. So Chinese consumers are stuck in a rut, and the data shows that they have not been spending. Now, this obviously has a flow-on effect to businesses as they produce less revenue and less profit, and naturally, it has really hit their share prices. But I don't think anyone is saying this is the end of China, right? And this is where Burry's thesis comes in. There's no doubt these big Chinese tech businesses are some of the best businesses in the world. You have world-famous investors like the late Charlie Munger, Mohnish Pabrai, Guy Spear, Howard Marks, Ray Dalio, all singing their praises. So the overarching thinking is one of proactiveness. China will likely return to being a powerhouse economy. These Chinese businesses are uniquely positioned to capture an incredibly large amount of business thanks to the size of their market, which is over 1 billion people, and also the fact that they more or less block Western competitors' access to that market. So is it worth establishing a long-term minded position in these businesses now at share prices that have been crunched 60 to 70% and then simply wait out the economic storm? That's the thesis of many investors right now, and it seems to be the thesis of Michael Burry as well, particularly when you consider two main positions at JD.com and Alibaba, which are predominantly e-commerce businesses whose revenues depend greatly on the spending behaviors of the broader population. And it's a take which might already be on the right track. That report that McKinsey put out a month ago notes that Chinese retail sales in the first 2 months of 2024 show a healthy year-on-year increase of 5.5%, with goods contributing a 4.6% rise. Food service sales leapt by 12.5%. Air passenger numbers soared by 44.4%. And even the auto industry is bouncing back, with auto sales growing 17%, with specifically EVs rising 37%. Spending is starting to increase, and in all three of Burry's China bets, you can see the share prices really ticking up in the past month or so. So they're the main two themes of Michael Burry's portfolio, the bet on gold and also the bet on Chinese tech. However, I guess you could make an argument that there is a sneaky third theme as well, and that is his cash pile. While the 13F doesn't actually tell you anything about cash, it does show you the total portfolio value. For Burry this time around, it sat at $103,488,000. However, if you look at prior quarters, you can see that that number changes a lot. And for someone like Michael Burry, this is not because his portfolio returns are extremely volatile. It's simply because he's putting money in and pulling money out of the market as he sees fit. As you can see, while his portfolio value is $103 million now, going back a few years, at some points it had up to $165 million invested. Then in the very next quarter, he had just $3 million invested. I assure you, he did not suffer a catastrophic 98.2% loss in one quarter. He just pulled his money out of the market. So with that said, how much money does he actually manage? Well, if we open up his form ADV, we can actually see that Burry manages around $238 million. At least that was the size of his fund at the 17th of January this year. So that represents a potential cash position of 56%. And that high cash level is consistent with most quarters going back in the last few years. What does this tell us? Well, it shows us that despite him chopping and changing large chunks of his portfolio and us being alerted that he's just added to 11 stocks and he's bought into another 5, in reality, he isn't finding that many significant opportunities in the market right now. Remember back when he bet against the housing market in the mid-2000s, he had one massive bet because he saw that as such a big opportunity that he needed to go all in on it.
You must have been pretty confident that this thing was going to blow up.
Well, we had a giant bet for us, and I was extremely confident in the outcome. We made $725 million, I think, on the funds in 2007, and in the first 6 months of 2008, there was about $730 million in withdrawals. Perhaps I had made the trade too big for the fund, and my confidence in the trade had ticked off some people.
And when you understand that he is willing to bet heavily when the time comes, it kind of makes sense that even these $7, $8, $9 million positions at the top end of his portfolio are not really all that significant. JD is the top stock in his US portfolio right now, worth $9.86 million, but compared to an estimated fund size of $238 million, it's only 4%. So who knows? Heck, maybe he's just sinking all his money into US treasuries at 5.5%. So you really do have to be careful when you read these 13F filings to try and step back to put together the bigger picture. For example, we mustn't forget that 13F filings, again, are just an SEC filing, meaning that it only shows us what's in their US portfolio. It tells us nothing about Burry's potential international investments. So when you zoom out, there are definitely limitations to looking at these filings. Don't get me wrong, love looking into them. They're extremely helpful, but you have to be careful that you understand the full picture. While we spoke at length about Alibaba and JD and Baidu, after looking at the complete picture, putting all of these investments together only represents a small percentage of Burry's total assets under management. But with that said, guys, thanks very much for watching. Hope you still found the video useful. If you did, please leave a like and subscribe. If you would like to learn how to go through the full value investing strategy, you can definitely check out New Money Education down in the description. But apart from that, guys, thanks very much for watching, and I'll see you guys in the next video.